Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. I was scrolling through Twitter, wanted to respond with data and information of why I think of what this person's comparing or whoever's comparing, I don't know who it is, Real Vision, of the data behind kind of the reasoning that some of these things fell. When you go through a cycle, and I'll go through a cycle here real quick, you're going to see that the business cycle is linked with the real estate cycle. They're intertwined here. And if all you do is look at potential chart patterns or fractals, you have to make sure that the underlying market conditions are also equivalent. They're the same. You'll have different outcomes if the market conditions are completely different. I'm not saying that these are necessarily completely different, but I'm just giving you data and you guys can determine what you think the differences and similarities are between the market conditions. And I'm going to use the real estate market as my gauge for what I think drives human behavior in these markets and drives the chart patterns that they are putting up here. So the humans interact a certain way given certain market conditions, increasing interest rates, declining interest rates, high inflation versus low inflation, et cetera, et cetera. The inflation and the tempo of that inflation is basically, I'll say, paced by the housing market. That's why I'm showing you housing market data, which then prices assets differently given where you are in that cycle. So let's look at what I'm talking about here. So this is Real Vision. I was reading this. It says the four most expensive words in the English language are "this time it's different." And then they post a chart of the S&P 500 during three different time frames: 73, 2008, and today. They say that this is a bull trap, and potentially a bull trap, and that it is going to go lower. That's what they are saying. Now, I know a little bit about history. I know about the real estate market. I know about these things, and I know that the real estate market is a large driver of crashes. And I know that 73 and 2008, since I've studied history and the real estate market, also lines up well with real estate crashes of these timeframes and eras. So let's look at the data and see if these 1973 and 2008 market conditions align with the market conditions today, and see if we could get maybe a rapid decline in the markets like this person is suggesting, or whoever. I know it's Real Vision. I don't know who posts stuff on Real Vision, but let's take a look. All right. So if I pull up, this is the real estate market. Oops, I meant to hit this one. This is the 18-year property cycle. What they posted was basically the spot where we're over here. We're starting to decline, and then you get an overall stock market crash that happens on the recession side of the property cycle or business cycle. So that is what they are inferring, as they're showing that 1973 and 2008, they basically peaked in the housing starts in 2005 or 6. I'll show you when they peak exactly. The housing starts rolled over, and we had a crash in the real estate market and the end of a business cycle and a recession after that business cycle. And I'll show you what that looks like in terms of inventory of homes and the housing starts and all that stuff. So right now, I'm going to give you the current information that we know today about our markets right now in the real estate market. So what this person believes is the answer is build more, a lot more. Rough estimates of what economists call the housing gap. How much the United States would have to build to bring it back in line with historical trends aren't difficult to come by. It says Freddie Mac, government-sponsored purchaser of mortgage-backed securities, estimate the current supply shortage of 3.8 million units, driven by a 40-year collapse in the construction of homes smaller than 1,400 square feet. The group Up for Growth also arrived at an estimate of 3.8 million. And then the National Association of Realtors compared the issuance of housing permits with the number of jobs created in 174 different metro areas. What they come up with, the NAR estimates an underbilling gap of as much as 7 million units. And that varies and is based off different cities. So every person who has looked at this, done an analysis, comes up with about a 4 million shortfall or greater in the homes that haven't been built. It's underbuilt by about 4 million homes. These cycles, this cycle here, when we hit the top of this cycle, it's called, by definition, a hypersupply phase. A hypersupply phase means that your inventory will grow above 10 months of inventory. And this 18-year property cycle ceases to exist because we're choking on inventory. That inventory crashes the housing starts, it crashes the real estate market, and interest rates will not bring it back to life for a long time because they overbuilt in a hypersupply phase. So by number one, this analysis is still valid in 2022, 2023, and we have not built those homes. So when we look at our inventories, just to start at inventories, this is history. Our inventory level is where the star is at. So the star is indicating that we are underbuilt, is indicating that we have a low amount of inventory of homes. That low amount of inventory is about 3 months. That's where it's at. In 1973, we were in a very dramatic increase of inventory of homes, and we hit about 8 to 10 months of homes during that time frame. That is generally when you get a stock market crash, basically a crash of everything. The real estate market crashes, loaning and lending and credit expansion crashes, and we get a recession, generally speaking. That also happened. The other time frame that this article or this graph is referring to was back in the 2008 timeframe, where our inventories peaked above 10 months of inventory in 2008 and created a very large crash in housing. And we also had a deleveraging event in that timeframe. So when we look at the information that's given and the timeframes that they show us, just looking at U.S. new single family months remaining inventory, we have differing market conditions and differing rules, and I'll say given information, different market conditions for a potential no crash scenario. And the no crash scenario, and I'm not stating that we can't crash, I'm just saying from the housing market, it won't be a crash from the housing market, as they're comparing the same periods to the housing market crashes of before. This is a housing market crash, and so is this one. We don't have the inventory like we did back during those timeframes. And if we did have inventory, it's going to take a long time to get it up to 8+ months of inventory, and it's probably going to take a lot of home building to get us there. So I don't think that 1973 and 2008 are valid time periods to compare to our current situation, given real estate and the business cycle and our inventory of real estate. This is our current real estate when looking at it in real time. We're at 577,972 units. It's actually declining of our inventory, which means that when we look at data real time, we've been declining in our inventory from November of 2022 onward. And yes, we're up 68% from a very low level of the year before, but the inventory isn't at a high level. It is actually at a level that is below basically all of history. So we don't have the pressure of the crash coming from the real estate market. This is what it looks like inventory-wise. Looking back from February of 2020, we had 800,000 units for sale, roughly speaking. We're coming on down, and yes, we did a little bit of wobbles through here, and we've come back up since early 2022, we've come back up in inventory, but it is coming back down, and we'll have to see how far that goes back down, and how this thing cycles with seasonality like that. But this is just a different way to look at our inventory levels. And our inventory levels right now are still lower than any time in 2020 with the gigantic price booms that we had back then, and obviously much lower interest rates and better affordability. This is the United States housing starts. So this is our housing starts, and you can see that the housing starts declined after September of 72. We went way down, and this is what was causing that crash. That crash during that time frame obviously impacted the S&P 500. This was also a time frame when we had massive moves and multiple waves in the commodity cycle. It finally broke down below the average in June of 1974, the housing starts. Looking at the last cycle, we also had a commodity bull market in an expansionary phase of real estate, which is inflationary. And our crash of housing starts started in December of 2005. It gave us plenty of heads up. And then we had the ultimate crash of July 2007 as it broke below the average housing starts. Right now, if we look, we're still moving in an uptrend fashion, and we haven't overbuilt at all. We haven't made any progress towards that 3.8 million home deficit that some people have projected. In order to make up that deficit, what you have to do is you have to build above the average for a period of time to catch back up the housing starts, I should say the homes in the system, to get back to equilibrium. So what we're looking at is the area under the curve needs to equal out this underbuilding scenario here. So we're massively underbuilt. We haven't built the homes. We don't have inventory right now. So my question is, where is the inventory going to come from to create a crash? Now, I'm not saying that the S&P 500 can't crash, because it obviously crashed in 2000, 2001. And I think that's probably the likely area that we're at, which is basically we dip below this trend line like we did in 2001. And then I think we're going to go back up with a lowering of interest rates at some point, because perhaps the system can't handle the rates. But even if they were to keep the rates high, higher rates will slow down the housing market. It won't stop it, because we're underbuilt. It's a supply-demand problem. So that's my take on housing starts, and we are not seeing the same type of decline in housing starts as we did during those crash periods. And we're still holding on, at least at this moment. And I think it's more similar to 2001. This is the U.S. historical foreclosure activity and rates. So we are still at a very low level. This is for looking backwards at the year 2022, 324,000. We're about half of what it was in 2005. 2005, we had a really rampant rise in foreclosures, which is deflationary. It's credit being destroyed in the system. Right now, we're still very low, and a lot of credit has not been destroyed. And with the inventory levels at where we're at, these foreclosures should be easily absorbed by the system. So I don't see a problem here coming from foreclosures at this time. But it doesn't mean it can't get worse, and it doesn't mean it can't become a problem in the future. Delinquency rates on all loans. So these are the delinquency rates, which is looking a little bit before those foreclosures. And this is for all commercial banks, and it is still at a very, very low level. Again, it doesn't mean that it can't come back up, but even if it comes back up, I think we still have time before an ultimate crisis or recession happens, perhaps. It doesn't mean that this can't just rocket higher. It's possible. But right now, we just don't see the data to support a crash from the real estate market based off of foreclosures, delinquency rates, and the inventory levels are not showing us that as well. and the housing starts are basically remaining resilient. It was up 10% last month. So we don't have the same signals in the real estate market like we did in the crashes of 73 and 2008. And if we look at real estate loans, this is real estate loans, all commercial banks. When this is going up, it is inflationary. The steeper this curve is, the more inflation into the system it has, and the impact on commodities is even greater. And what this is money is being created faster than goods and services in the system. That is inflationary. This is the credit expansion that is occurring, and that credit expansion puts everything into a shortage. Energy, specifically oil and natural gas and stuff, they can't keep up with the rate of change of credit growth. And when they go to build more products because of the inflation and the higher demand, that is why oil gets priced higher, because there's a supply shortage of oil in relationship to the credit expansion or money supply being grown in the system. Then you can see the deleveraging or credit destruction in the system as the loan growth turned negative back in 2009, 10, in those times frames. But as you can see, we had a recovery phase here. Now we're going at a steeper rate, which is a inflationary time frame. So real estate loans are still growing; they're not crashing, and they're going up at a pretty steep pace. And this is the most recent data from March 20, which is today, of 2023. So when we look back at this, I don't think 1973 and 2008 are necessarily going to happen the same way. And I don't know that these two fractals are necessarily the same as this fractal. If you look, the fractals do look different. These two do look the same, but they also have identical housing inventory, housing start crashes. It's basically two crashes that were formed by the real estate market and the end of the business cycle crashing. I don't know if I can make that conclusion for today. And even though they may think that this is necessarily the case, I could also argue that this fractal is just jammed up tighter than these two fractals. You could say that hump number 1, 2, and this is the third hump. Hump number 1, 2, this is the third hump here. And well, you could even argue that this is the third hump there. It came down, and all of this section, you could argue, is this section down here, and that the crash has already happened. And it's not as large as the other ones because the real estate market wasn't the driver of it. Possible, yes. Could this still crash out to the downside? That is still possible as well. I'm not saying it can't. But the underlying market conditions that are backing the crash of these two markets are not the same as today. That is what I'm saying. I'm not saying this time is different because these two eras are not the same as this. So what he's saying is this time it's different. Well, he didn't grab the same two market conditions. So today is different than 73 and 2008 with respect to the drivers of the crashes of these two versus the driver of the crash of this. The driver of the crash today, in my opinion, is driven by a repricing of stocks due to interest rates, much like the pricking of the NASDAQ bubble. Those went down because interest rates went up. 73 and 2008, they had higher interest rates, but that was a housing market crash in both of those scenarios. So that's my opinion on it. If the housing market continues to go up, that means that we're still in an expansionary phase. The S&P 500 may or may not go down depending on what interest rates do. If interest rates continue higher, I would say, yeah, there's a good likelihood that there's a strong headwind for stocks to go higher. It doesn't mean they can't go higher. It just means there's a headwind to it. But I don't think that 1973 in 2008 are the same as today, based off of the real estate market, the homes in inventory, the housing starts, and all of those things related to that. But that's what I've got for today, guys. Hopefully you enjoyed it. Give me a thumb up on the content, subscribe to the channel. Check out my finding-value.com website. I can help you sift through all this information. Be careful what you're listening to on YouTube and what you're reading on Twitter. I don't know if a lot of these people have done any deep dives and connected the real estate market and the financial markets together, because in my opinion, the real estate market is driving the financial markets and the pricing of assets through inflation and deflation and interest rates. Interest rates just chase the inflation or deflation in the system. But that's what I've got, guys. We'll catch you next time. This is Finding Value.